There is a famous saying that goes, "The final stage of grief is acceptance." And while it seems the bulls have officially accepted their fate, and by accepted I mean thrown in the towel, waved the white flag, and possibly started drafting their resignation letters, uncertainty keeps rising, trade tensions keep escalating, and sentiment is in the gutter as bears just keep winning day after day after day. So when will the selling end? That is the question I will answer today. We will look at earnings revisions, previous drawdowns, global liquidity, and seasonality to determine if we bought it sooner or later. The answer is not as straightforward as it seems, but I have the answers nonetheless. So stick around as we dive deep into the data and uncover what's really driving this market and what might finally turn the tide. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks fell on Thursday with the S&P 500 officially entering into correction territory as economic concerns grow and investors digest the latest inflation data, President Donald Trump's trade offensive, and a looming US government shutdown. Very red day, very volatile day. There was a lot of news that came out today that impacted stocks negatively. And if we actually go ahead and just look at the stocks that outperformed, or I should say the sectors that outperformed, utilities was slightly in the red right here. Health services, okay, this is the defensive component of healthcare, was flat to green, and then communication services was deep in the green. These are highly defensive sectors. A couple of other defensive names were green, stuff like Berkshire Hathaway, right, and then a couple of healthcare technology names, stuff like AbbVie, Merck, those names. Other than that, it was deep red territory. Tesla fell 3%. We saw Amazon, Walmart, Costco, Home Depot, retail discretionary as a whole take it on the chin. Software technology was very red. Microsoft, Google, Meta, Oracle, Netflix, all of these names were very red. It was a brutal day for software. And then looking at the hardware and semiconductor side of the tech sector, Nvidia was flat, outperforming today, but Apple fell 3%, AVGO fell 1%, Costco fell 1%, and it was a mixed day, but mostly in the red, financials in the red, and it was just a red day across the board. I feel like a broken record saying all of these sectors were in the red. And looking at the sector analysis, there was only one green sector, that was utilities, and then gold was up 1.78%. And we're going to talk about why. It had to do with the tariff situation. And again, the market positioning in a defensive stance, but even the common defensive sectors, stuff like staples, stuff like healthcare, really took it on the chin. So really what we saw was somewhat of a liquidation, mild positioning into gold and utilities, and the S&P 500 down 1.33%, officially in correction territory, which is a peak to trough drawdown of 10% or more. And generally speaking, corrections turn into bear markets only 25% of the time. So that would mean the correction moves from negative 10% to negative 20%. That happens about 25% of the time. About 75% of the time, we actually skip the bear market in aggregate. So more likely than not, we are very close to the bottom unless we see further deterioration in the macro and in the earnings picture. But we'll talk about that in the sentiment, seasonality, and macro portion of this video. So stay tuned. Small caps, mid caps, large caps, growth as a whole took it all on the chin. The only two outperformers were mid cap value, large cap value. They only fell 0.7 and 0.3% respectively. All these other segments were deep in red territory. For the most part, every single factor and size segment fell today. Now, there was a couple of reasons for this. Now, economic data was actually significantly better than expected. However, the PPI data was already front run by the CPI. So we kind of expected the PPI data to come in cool, and that it did. You can see that the producer price index came in at 0%. We were looking for a gain of 0.3. Core PPI came in at 0.2. We were also looking for a gain of 0.3. And then year over year for headline and core came in at 3.2 and 3.3. The expectation here was for 3.3 and 3.4% respectively. So PPI came in cooler than expected. Initial jobless claims came in cooler than expected, 220,000 versus 225,000, the forecast. However, the market didn't sell off on this economic data. We knew it was coming. Market was reacting to Donald Trump as well as the EU. Now, the EU retaliated against Trump's tariffs with $26 billion in countermeasures. US goods to be affected from 1st April include whiskey, jeans, and Harley-Davidson motorbikes. You really think that they would want to tariff more essential goods, but this is what they plan on placing tariffs on. Donald Trump certainly did not like this, especially with the whiskey. And he came out, posted this tweet. He said the European Union, one of the most hostile and abusive taxing and tariffing authorities in the world, which was formed for the sole purpose of taking advantage of the United States, has just put a nasty 50% tariff on whiskey. If this tariff is not removed immediately, the US will shortly place a 200% tariff on all wine, champagnes, and alcoholic products coming out of France and other EU represented countries. Now, guys, there's a lot of chatter about this, and pretty much the word on the street is that a 200% tariff would essentially eliminate EU wines from the US. These companies would not export wines to the US. We'll see how that plays out, but things are really escalating. And this is why we actually saw the market price action, which was pretty volatile today. We saw Europe really take it on the chin, kind of green, kind of red, but mostly in the red, especially the big economies. China, Asia was also red. Same with Australasia. South America was the only green, except for Mexico, they were red. US was deep in the red. Same with Canada. It was a red day through and through here in the markets. Now, something else that's bringing uncertainty is a government shutdown. Schumer says Senate Democrats will likely block the GOP funding bill. So this vote is happening sometime today or tomorrow. We'll see how Democrats vote, but it's likely we will see a government shutdown and all of the entire circus that comes with that. Now, looking at a couple of market movers, Dollar General was up 7% today. Now, they dropped their earnings. They beat revenue and earnings. They topped estimates respectively. Management also came out and said after a review, the company plans to close 96 Dollar General stores and 45 Pop Shelf stores and convert an additional 6 Pop Shelf stores to Dollar General stores in the first quarter. Same-store sales rose 1.2%. The street was expecting 0.93%. The street loves to see that, and that is why the stock rose. However, guidance was kind of mixed. In fact, guidance came in line with same-store sales growth as well as EPS growth. However, they missed on the revenue side, but the market kind of brushed it off, saying that probably based on the environment we're seeing right now, dollar stores are probably a best bet with regards to their defensive characteristics. That is why Dollar General was up 7%. But we saw a double beat, inline guidance, except for the revenue part that came in slightly below expectation. Analysts were expecting revenue growth of 3.96%. The midpoint of the guidance was closer to 4%. So it was a slight miss here with regards to revenue growth. However, the market kind of brushing it off and telling you, the street telling you they do like those earnings. Intel was up 15%, completely bucking the trend. That's because Intel appointed an industry veteran as its new CEO to right ship the chip maker. There's also news about NVIDIA, Broadcom, and TSMC buying Intel's foundry business, which is their loss-making business, and taking it over and potentially implementing a 2-nanometer process into their business. We'll see if that takes the run of the mill. However, the market looking very favorably at this news, up 15%. There were only 1,800 advances, 4,400 decliners. Market breadth was absolutely terrible. We saw net outflows on the day. The S&P 500 down 1.4%. And market momentum again in the dumps. There's no respite for the bulls. Shorter term, medium term, longer term averages well below the 50% mark. And guys, you won't see a rally and all-time highs being taken out unless we get these numbers, longer term, medium term, and shorter term averages above the 50% mark. Right now, they're in the dumps. Now, guys, looking at the charts, looking at equities, we can see a very red day across the board. The Nasdaq 100, the S&P 500, the IWM, the RSP, small caps, mid caps, they all fell in excess of 1.5%. The best performing was the RSP, down just shy of 1% as a whole, but looking fairly upbeat here in the after hours. I'm not sure if there's news. Maybe Trump made a tweet rolling back some tariffs. I'm not really sure. I do know that there is a ceasefire going on right now. Both Russia and Ukraine have agreed to a 30-day ceasefire as they outline and agree to terms. That's very, very positive for the market. As a result, today we did see yields fall because the economic fundamentals continue to weaken, but the dollar did gain on the tariff threats from Donald Trump. So that price action is going in there. We did see volatility volatility tick up, but it looks like we are approaching the top end of the range, and spot volatility is still higher than the front month volatility, telling us that this volatility does have an expiration date, and that expiration date is the March OPEX. We'll talk about it a little bit later on. High beta Bitcoin fell 4% today. Gold is up 1.85%, and gold being a great outperformer. We're going to look at gold. It may have actually touched my $3,000 target that I made on the 1st of January this year. But let's go ahead and actually talk about the S&P 500. Guys, in 18 trading sessions, 3 weeks in the calendar terms, we have fallen 10% peak to trough. This is officially a 10% correction from the top of all-time highs to the close today. 10% the S&P 500 has fell. And for those of you that follow me on this channel, you know that what we are looking for right now is a pullback into this area right here. We're looking for a pullback. This is where we're finding support, and we're trying to find that support at around the March OPEX, simply because of what the VIX is telling us, and it's also a quarterly OPEX. Generally speaking, these quarterly OPEXs are major turning points. We've seen a massive pullback here to the year off, and now we want to look for a move to the upside. Okay, now that is what we're looking for right now. However, it is void if we go ahead and break below this level right here. 5,400 is absolutely key for the bulls to hold. Yes, we can pull back, but you need to hold this level. If you don't, we are definitely going to go lower, and we could see a possible correction in the S&P 500. And where would a 20% and 15% correction put us in the S&P 500? 15% would put us at around the 5,200 mark. A 20% pullback would put us at about the 4,900 mark. Yeah, about the 5,000. So 5,200, 5,000, around about there. That would be a 15 and 20% correction. We're looking at about a 10% correction right now, but it's absolutely imperative we hold this 5,400 area. This is the buy zone right here. I should actually go ahead and actually measure it up right here. This is the buy zone. But in terms of our day-to-day, week-to-week levels, we are near the bottom end of the put support, meaning that there is still a little bit of downside to the 54.85 area. I do think that we are going to end the week at the bottom end of this range. We could see a little bit of a bounce Friday, but don't expect anything major, and definitely don't expect us to get back to the gamma flip. We are clearly in a daily downtrend, and that means if you are a bear, you want to be taking shorts on any pullbacks we do get until the March OPEX period. We're in negative gamma. Dealers sell into weakness, buy into strength. So we can see sharp moves. Don't get me wrong, but don't hold your breath for a massive pullback immediately. That's only going to come at or around the March OPEX. And again, guys, that is on 21st of March. And I'm not saying that's the exact date we're going to bottom, but at or around that date right there. And again, don't take these levels as exact zones. Maybe you can look at them as general levels. Sure, we can go a little bit lower, but as long as we close within this area, that would be good. We could see a wick below. That's completely fine. It's all about the nuance of the trade. The NASDAQ 100 on a peak to trough basis, I would love to see what the drawdown is right now. On a peak to close, we're looking at about a 13% range. In fact, we actually only just managed to get to the low of where we were here on Thursday or Wednesday. Very interesting trade. We definitely are seeing dip buyers come in here in this positive gamma. Look at these wicks, right? That is buyers stepping in front of this move right here in the NASDAQ 100. And what's so interesting about all of this is that a lot of the Magnificent Seven names, yes, their earnings have come down, but not materially a lot. When you look at something like NVIDIA, right? In fact, NVIDIA had upward earnings revisions since their last. NVIDIA had upward earnings and revenue revisions since their last earnings call a couple of weeks ago. But then on a peak to trough, right, they're actually at about a 23% drawdown. Look at something like Amazon. Amazon has had 0 earnings revisions. However, on a peak to trough drawdown, Amazon is down about 20% from their highs. So what we are actually seeing is maybe some form of a valuation reset. If earnings stay the same and markets pull back, the multiple compresses, that is what you want to see. So we see a lot of multiple expansion over the last year. Now we're seeing multiple compression. That is simply how the markets work. But going back to the NASDAQ 100, we definitely are seeing buyers step in. And that's because the fundamentals simply make sense. However, we are negative gamma, and there is still a little bit of downside here to this 19,000 mark. What is positive for the bulls, though, is that these gamma levels didn't move down. They are staying right here. So the options market is telling you, hey, look, we like what we're seeing right now. We don't want to get any more bearish, despite what the sentiment and the market is telling you in aggregate outside of what the actual charts are. Remember, guys, the charts right here is telling you everything you need to know. The charts are the whole simple single and only truth. Looking at the RTY, down 1.21% today, and again, we're nearing the bottom of the range. It does look like we are probably going to touch these put support zones here for both the S&P 500, the Nasdaq 100, and the Russell 2000. Let's go ahead and look at the RSP very, very quickly. What is the average stock doing on a peak to trough drawdown? Just under correction territory, I would say. On the absolute lows, yes, you're in correction territory. So the average stock is in a correction as well. That is the RSP, the equal weight. Now let's actually go ahead and talk about gold. Did we actually hit 3,000? We did not. We are very close to the 3,000 mark. For those of you that are new to this channel, this is a zone where we are going to buy because I believe Scott Bessent, Donald Trump, are going to revalue gold at the 2,700 level. This would mean this would be the floor for gold in perpetuity. And then from there, it's onward and upward. If we go ahead and hit 3,000 gold, and if you're new to this channel, I did say that my year-end target for gold is 3,000. That may need to be revised, but Goldman Sachs came out and said their new gold target is 3,500, just based on all of the political uncertainty as well as geopolitical concerns. However, we are still waiting for a pullback here. I really do hope we get it in the gold picture. That would coincide with maybe the dollar increasing significantly and yield increasing. Then we would get a pullback here in gold. However, I wouldn't hold your breath because that is a very, very strong candle taking out all-time highs. And yeah, the market telling you that, hey, there's a lot of uncertainty and we want to be in safe havens. One of those safe havens is gold. Silver, not quite as bullish, not quite at all-time highs, but very close to 52-week highs. Very, very bullish here for silver. And again, what I want to see for silver is a pullback to the $28 region. If we get that, bet your house we're going higher because that is probably the floor. Metals looking very, very bullish in my honest opinion. I think Bitcoin, for those of you that don't have it, you can actually go ahead and download the FinFluential Global M2 Money Supply Indicator. It's completely free. If you hit the setting button right here and offset by 72 days, it actually provides you a very accurate path as to what Bitcoin might take. We've seen money supply increase significantly over the last, I would say, month or so. We're looking for a bottom, and around about the 26th of March, that would actually coincide with the OPEX that we do get with the major indices with stocks. You would actually see Bitcoin rally from there. It takes about 72 days for global liquidity to make its way into the financial markets, and that is why possibly we could see a rally for Bitcoin that would actually extend into the Nasdaq 100 and the S&P 500. And again, if we actually have a look at when that date is, 30th of March, potentially a bottom the 24th of March. Remember, the March OPEX is the 21st of March. So there's a lot of confluence factors that could really support equities, support risk assets over the next couple of weeks. And that is why, guys, I'm saying right now, think that you actually want to get incrementally more bullish. And when we do get to this buy zone, you want to buy now. Things can definitely fall apart. Don't get me wrong. We can definitely go lower, especially if we break the zone. Things can look a bit risky and dicey for equities. However, looking at probabilities, it's very likely that we are going to form a bottom, but I will update you day by day as we go. Remember, we react to market conditions. We don't really try to predict them. We just use probabilities to our side. But all in all, I'm still a buyer of dips. I bought some more stock today. Probably will buy some more stock. I probably will be buying stock over the next month. This is a very welcomed pullback in the market. Something we've definitely needed over the last 2 years, something we haven't gotten. And it's a great reset for us to continue higher, especially if we start to get certainty in a lot of the uncertain parts of the market and the economy with this administration. Right now, the bullish thing is we get certainty, we get trade deals, we get an official ceasefire, we get a peace deal, and then stocks can continue their upward momentum from there. But in the here and now, we just have to embrace this volatility. And to be honest, looking at it now, this pullback isn't scary just yet. But if we break this 5,400, that's when things look a little bit scary. But in the here and now, as a bull with a very, very long-term time horizon, guys, buy the dip. Don't get scared by this. In fact, maybe it's time to get bullish and start adding to the names you like. Stuff like PayPal, EVVTY, Nvidia, Google, Uber, those names, add to them, buy the dip, hold. You will be rewarded in the very long term.
And diving into sentiment, this is the AAI sentiment survey. Pretty much a survey asking, how do you feel about the market in the next 6 months? Essentially, are you bullish, bearish, or neutral? Very similar to what we do here on this channel with the community poll every single week. And only 19.1% of individual investors are bullish on stocks over the next 6 months. This has followed the trend being below the 20% mark, which is literally in the 95th percentile for this survey. Generally speaking, guys, when you have bullish votes below the 20% mark, the average return 1 year later tends to be about 17.4%. So this is the opportunity to get long. However, you can't deny the fact that with bullish votes here at 59.2%, there certainly is uncertainty in the market, and many people are feeling less certain about what's to come simply because of this administration. The policy uncertainty index has soared ever since election day, and as a result, the peaking out of the uncertainty index has resulted in the S&P 500 pulling back almost in correction territory. Now, a correction is a move of 10% or greater, and that's pretty much where we are right now in the S&P 500. The Nasdaq 100 is firmly in correction territory. So too is the Russell 2000. However, as a long-term investor, you always need to take the contrarian side of the market. Buying on corrections or major dips, even when in a recession, 6 months later, you tend to see returns of about 5% on average. No recession, 6 months later, you can actually see returns of about 8% or higher. 12 months later, you're looking at returns of about 11%. Again, that is if you buy the 10% dip. Generally speaking, 1 month out, you do see quite a bit of volatility, but assuming no recession, you generally see very linear returns. However, when a recession does ensue within the next 12 months later, you see flat to no returns, slightly positive, and that can be a worry. And we'll talk about in the macro component of the video if I believe we are going to see a recession. But what we are seeing coinciding with this policy uncertainty is that earnings estimates are getting revised downwards. They are getting slashed. Goldman Sachs lowered their S&P 500 earnings and valuation forecasts as the Magnificent Seven pushed the index into the brink of correction. They now forecast only a 7% EPS growth in 2025 and 7% in 2026. This is their top-down estimates. Looking at consensus bottom-up estimates are far more accurate. Just to give you guys the difference, top-down sort of looks at the macro picture, the economy, and then derives estimates from there based on overall growth, whereas bottom-up estimates looks at each company individually in the S&P 500, and then you get aggregate. And right now, consensus bottom-up estimates are looking for 10% growth. Just for the record, this figure is actually revised downwards significantly. Coming into the year, we were looking for 13% growth for full year 2025. However, Goldman's 2026 target of 14% is actually unchanged. And then looking at the consensus top-down estimates, they're slightly more bullish than Goldman's top-down estimates of 10% and 8% versus 7% and 7% respectively. So you got to ask the question, where is the truth? I would say somewhere in the middle. And for 2025, you probably want to aim anywhere for 7 to 10% in your valuation models. If you plug that in, the truth is normally somewhere in the middle. However, we are not seeing the same estimates being cut in Europe. In fact, Goldman Sachs raised the EPS estimates for Europe by 1 percentage point in 2025 from 3 to 4% and 2 percentage points here in 2026 from 4 to 6%. They kept their 2027 earnings targets the same. We also saw the IBES bottom-up consensus estimates increase for Europe ever so slightly. This is obviously the total index, and this is where Europe starts to make sense, guys, because when you look at 2025 bottom up as well as top down estimates for Europe, it's 6 and 7%, right? Going back to US equities, it's 7%. The bottoms ups are 10%, but it's around the same ballpark. However, when you look at the valuation, the US market trades 22 times, right? Excluding big tech, it trades at 20 times. When you look at Europe as a whole, it just trades at 13 times. So you're getting roughly the same earnings growth for a significantly cheaper valuation. And in some instances, for example, the United Kingdom, you're looking at half the valuation that you would for the entire US market being the United Kingdom. And this is why I say Europe makes sense right now. You're getting roughly the same earnings growth this year for, in some cases, half the valuation. So I wouldn't blame individuals for starting to look at Europe. And this is actually why I bought the stock EVVTY. I was a bit ahead of the curve here. And this is an ADR that trades on the US market. However, this is a Swedish company that's growing earnings and actually have seen their earnings revised as of late. It's part of the reason why I did buy that, just to get some exposure to Europe because I didn't want the ETF. Other stocks I'm looking at in Europe is a company called Kering, K-E-R. They own the Gucci brand. Airlines as well, and a couple of other defense companies. But in tomorrow's video, we're going to talk about Europe and the stocks I like in Europe, but on the second channel, FinFluential Media. So go ahead, follow me on FinFluential Media so you don't miss that. Now, guys, let's actually talk about the macro. And this is very interesting. Despite everything we've seen, the policy uncertainty, Goldman Sachs came out and their economics forecast for GDP real growth right now is sitting at 2.4%. The consensus is 2.3%. So we are still expected to see pretty robust growth, pretty much in line with what we were expecting at the start of the year, and very similar growth numbers in 2026. In fact, the consensus has just lowered ever so slightly on these numbers. Goldman Sachs keep their forecasts the same. We also got inflation data yesterday, and housing inflation hit its lowest level since December 2021. Overall inflation also ticked down below consensus estimates. That's exactly what you want to see. This type of inflation data will give the Fed the power to cut rates. And overall, this inflation print marked the lowest yearly increase in core CPI since April 2021, meaning that inflation continues to decelerate. This is exactly what we wanted to see to get rate cuts. And I think part of the Trump economy actually wants to see this. They want to lower inflation so that they can actually get yields, the 10-year yield lower. Scott Bessent was talking about that a lot. Now, a big thing that everyone's been talking about is stagflation. Stagflation is essentially slower growth, higher inflation. And guys, this was something that was always floated there, but now the inflation reports we're getting, as well as some of the growth numbers, are flying in the face of that. And you have to understand that 95% of time, we just avoid stagflation. Stagflation is this right here. In every other instance, we generally just avoid it, and the economy continues as per usual. It's very hard to get into a stagflationary environment, especially with all the policy levers we have now to pull. However, the risk of recession is still here. Betting markets putting a 38% chance on an overall recession. So we're 38% of the way there. This is within 2025. This is up significantly from January, where we were looking at about 15 to 17% chance of a recession. So Trump's policies uncertainty have really put the market on edge. But the bigger risk and added uncertainty coming this week is a government shutdown. The gap funding bill actually passed the House. It's now going to go to the Senate. And Schumer came out and said that Democrats will block the GOP funding bill. I've seen some other sources saying they're not too sure what they're going to do. However, they do need 6 Democrat votes in the Senate for this to pass. And if a deal isn't made, the government will shut down at the end of Friday, excluding essential services. So this is the biggest uncertainty we're seeing right now. However, it shouldn't really affect the trajectory of stocks for the most part. It might just add a little bit of uncertainty. Looking at earnings for the rest of the week, tomorrow, Friday, there isn't much of anything. And the only big data print we have is Michigan consumer sentiment. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.